my name is Katharina Pistor. Many of you know me. I'm the co-director of the Center for Political Economy, and I'm co-chairing with Matthias Thiemann the Law and Finance Lab at the center. We have been running as the Money and Finance Lab, I should say, Money and Finance Lab, this series on the political economy of liquidity now in the second year, asking ourselves in this year in particular, who really governs the global financial system. And I'm incredibly happy to be able to introduce our two guest speakers today, Ellen Rai and Anusha Chari, and they will take turns presenting their views, and then we will open it up for discussions. William O'Connell, one of our postdocs next to Dario Laudati, who chaired last time, will be chairing the session today. So without further ado, I'm just going to hand it over to Ellen.
Thank you so much, Katharina, and thank you very much for inviting me to speak to this very special set of people. I'm very, very glad to speak with that audience and to be discussing these issues with all of you and with Anusha. So I've been kind of told to discuss monetary policy autonomy and financial globalization, which is obviously also very related to the structure of the international monetary system. And what I thought I would first do is give you a few ideas of how I see interlinkages across economies in both in international finance and international trade, and international finance being, I guess, the crux of the matter for this talk. Discuss the role of US monetary policy from a macro point of view and also a very micro point of view, and then put on the table the recent surprises that we have, and maybe try to find out why we have had these surprises or how things may actually be changing. So that's the menu, and I have 15 minutes. So I really always like to start my talks with these networks that I've been constructing with some co-authors, both in international trade, and you will see also the equivalent in international finance. Because I think they illustrate very well the type of interconnections that we are seeing in the world economy. So here you see an international trade network in 2000, so year 2000. So if you have a big node, it means you have a lot of exports and imports, and in value, of course. And the arrows are the exports of one country to another country. So if you see an arrow going from Japan to the US, that means Japan, that's the exports of Japan to the US. So you see there is a dense network of arrows, and you also see that there are big nodes in 2000, namely the United States, and what is called EMU, which is the euro area. But you also see Great Britain, you also see Japan, you also see Canada, etc., etc. Now, however, if we move towards 2019, you see that suddenly the shape of that network of international trade linkages has changed quite a bit. The interconnections are very, very dense, even denser. However, you see that the world has become tripolar. So from the US and EMU being the two big nodes, we still have the US and the euro area, but we also have China. So we really have moved to a tripolar world as far as merchandise trade here is concerned. I put here just for illustrations where the bricks are in that network, and you see that if we compare the 2000 to the 2019 network, we see that really the only BRICS that country that has kind of made a big move is China. Whether you look at India or Brazil or Russia, that's not the case. Now, I'm going to move on to the international finance network, just to make the point that indeed, if you look at the world through different lenses, through the prism of international finance compared to international trade, reality looks very different. Okay, and it's obviously very interesting to do some further networks that we can do on FDI, etc. But here I'm going to contrast international trade with portfolio investment. And what I have here are the portfolio investment positions, the cross-border ones, in the world economy in 2000. So portfolio investment, that's investment in equity and in bonds. And what we can see is that we have, again, two big nodes, the US and the euro area, and then we have also fairly big nodes, the UK, Japan, Switzerland, etc., Canada. And we have a very small China in that 2000 network. Again, so here the arrows are going to be the international asset position. So it's going to be the cross-border asset position, okay? And the size of the nodes is proportional to the cross-border assets and liability position. Now, if we move on to 2019, unlike the other networks, so we still see that the US and the Euro area actually are pretty big nodes and pretty important nodes in international finance. But China has not really become a very important node in that international finance network. So, and the US is still pretty much right in the middle. And so I think this is one illustrative measure of the importance of the US in the international finance network. I could show a lot more, but I'm not going to do it, on the importance of the dollar in many different markets and many different functions. So there is this asymmetry, I think, that is very important to note between what has happened in international trade and what has happened in international finance between 2000 and now. And we are still now in a world which is pretty much quite unipolar, with the United States at the center of the international finance network. And you can see that there the BRICS have really not made much change compared to 2000 and 2019, and that includes China. Now, on the other hand, the US is still very much at the center of the system. And if we do a very short history of US monetary policy spillovers over time in terms of the various crises that we have gone through, we have a very famous Volcker's tightening of the 1980s with the Latin American debt crisis. We had the Mexican crisis in 94, 95, following some hikes of the Fed. We had similarly the 2004, 2006 hikes with culminating in the what we can call the Great Financial Crisis or the North Atlantic Financial Crisis, whatever we want, followed by the Euro area crisis a little bit later on. We had the taper tantrum of 2013, which was not even a hike, but just an announcement of a decrease in purchases. And then we have the hikes of 2022, 2023, and I will come back to these recent hikes towards the end of this presentation. Now, what we know on historical data, and this is a kind of generalization, so I've shown you the big spillovers in a way that have translated to some extent into financial crisis. So what we know about US monetary policy in general is that US monetary policy has a very important effect, spillover effect, on international financial markets and on other economies. That includes advanced economies, and that includes very much emerging markets. And what I'm going to show you here is just an example of the type of work that I've been doing over the years, where I have been estimating impulse responses of the effect of monetary policy shocks of US monetary policy shocks on a number of international variables and a number of countries. And what I'm showing you here is a 100 basis point tightening of the Fed, so 1% tightening of the Fed. And I'm showing you the effect on the variables that are here listed, and I can explain a bit in more detail what they are. And on the horizontal axis, you have the months. So the months after the monetary policy shock, after the monetary policy tightening. And what you should look at is just the lines, which indicate the impulse response functions, and the areas, the gray area are just the confidence bands that we can need. I'm going to guide you to what is important here. So in particular, you see that I've put these green boxes. And in these green boxes, you can see that there is a very important strong response of world financial conditions. If you look at the top row, world private liquidity, which are decreasing in a very statistically and economically meaningful way. Same thing for the global factor in asset prices, which is an indication of the prices of risky assets worldwide. Same thing for the global component of the global factor in capital flows. So all these things are very strongly affected by US monetary policy, and so is the VIX. You see the last green box towards the bottom right. And the VIX is often thought as an index of a fear in international financial markets. So you see that when the VIX goes up, it means more volatility is expected and risk aversion is going up. So you see that the US monetary policy has a very strong effect on the VIX and all these global financial condition. Now you can look at these, the effect of US monetary policies disaggregating a little bit by different types of countries. And for example, here, what I have been disaggregating are the capital flows. So you see that when the US monetary policy is tightening, you see a decrease in inflows into the United States, a decrease in outflows. So this is effectively a decrease in financial intermediation activity for the US, and this is also going to be true for advanced economies in general. And if you look at emerging markets, you see a decrease in inflows and you see an increase in outflows, which means there is a net effect on capital flow. So here it's a lot more related to the current account. So it's essentially a net outflow. So this is essentially a current account effect as opposed to a financial intermediation effect for advanced economies. And we could also disaggregate by commodity exporters and importers. We would find also similar effects as in tend to be as emerging markets. So more generally, this US monetary policy tightening is affecting the dollar very much. All the aggregate indices implying the dollar. So for example, the BIS here, real effective exchange rate of the dollar. If you have a tightening, you have an appreciation of the US dollar. Any global factor in asset prices, in capital flows, global measures of global risk aversions, which are going up with the US monetary policy tightening, measures of leverage, both of US broker-dealers, but also historically of EU global banks, which were very, very important before the 2007 financial crisis. And more generally, leverage of various intermediaries tends to go down when there is a tightening of US monetary policy historically. So that's the kind of macro effect, which is very much, I think, a signature of a tightening of US monetary policy. And now, what is also nice is that one can do some further research using microeconomic data, very detailed macroeconomic data on portfolios, and take a look at the effect of US monetary policy on how different investors are rebalancing their portfolio when there is a tightening of the Federal Reserve. So this is this point 3 here, where we can literally zoom in and look not only at what I've shown you on the leverage of global banks, also I've done work on global credit creations, on various measures of risk appetite, but really on what is happening to the portfolio of various investors. And here I'm going to base what I'm saying on some work done by a student of mine at Svetinenova, who is now at the BIS, the Bank for International Settlement. And she has used data, very disaggregated data on mutual funds based both in the US and the euro area. So that's a very, very large chunk of the market. And she's looked at fixed income, so mutual fund investing in essentially in bonds. And she has looked at what happens to the rebalancing. What do they do when there is a tightening of the US Federal Reserve in the disaggregated data? And what she finds is very interesting. So she is able to estimate elasticities of substitutions across the different bonds, and so see which bonds are sold when US T-bill return goes up, when there is a tightening, essentially. She can also estimate all kinds of elasticities of demand, safe assets, unsafe assets, etc. But here I'm just going to focus on this. So when the Federal Reserve hikes and the US Treasury bill goes up, what are funds selling? And what she finds is that these funds tend to sell risky US bonds. So the way you see it here in this graph is that the stuff that is sold is the stuff that is substituted out are the long bars. So you see this red box here. This is the stuff that is most sold. This is the most substituted out in the fund's portfolio. You see that it's the risky bonds. And in terms of credit rating, by bond maturity, these are the same types of maturity as the US T-bill. Okay? And in terms of issuer regions, what we see is that this is essentially, besides the risky US, you also have the emerging markets are the ones that are the most sold. And among the emerging markets, there are slight differences. Latin America tends to be sold quite a bit, but all the other emerging markets tend to be sold. So there is really this substitution out of risky US assets and emerging market bonds into safer US Treasury bill. Very interestingly, but I won't discuss it here, the pattern of substitution when it's the ECB hiking among, in particular, the European funds is very different from this. But here, focusing on the US Federal Reserve, this is what we see. We see that the elasticities of demand for emerging market bonds and high yields are the highest. So that means they are the ones substituted out when there is a tightening. I think this is highly consistent with an observation that has been made a lot, which is that usually there is a little bit a similarity in spreads between emerging market bonds and risky US high yields, in particular when there is tightening of global financial conditions. Now, knowing all of that, okay, and so having looked at all this past research, and there is a lot more on all of these topics, obviously, and Anusha will have a lot more interesting things to present, also in a very related way, I think. There have been some recent surprises, in the sense that if we look at all our indices of global financial conditions, liquidity indices, etc., in the recent period after this 22-23 recent Federal Reserve hikes, I think every one of us, we were expecting that there would be much more of a disruption in international financial markets, given how abrupt the Federal Reserve hikes have been, and if we were to compare that to the historical evidence. Okay? And so in a way, the surprise has been a good surprise, but there hasn't been as much disruption in emerging markets in particular. And also, and I think that's important, in high yield bonds compared to what we would have expected in terms of historical patterns. So here I'm just putting an update of the Global Financial Cycle Index that I've been developing with Silvia Miranda Agripino, and you can see that usually, so when we have all these episodes, we have pretty strong effect on the global financial cycle. The recent period looks relatively benign. I mean, the hikes have not translated, and you could put any of the liquidity indices, etc. This would be very similar. So the question is a bit why, okay? And this is something probably we can discuss. There has been several hypotheses, I think, that have been put forward. So some have to do with this monetary policy autonomy of emerging markets has become better because they have had better monetary policy frameworks, inflation targeting. There has been less foreign exchange debt in EMs, smaller external deficits, maybe more reserves, better macroprudential policies. So all of that is certainly true. Key emerging markets have changed their monetary policy framework. But that certainly all of that has helped. But I think the one thing that makes me question a little bit that it is the end of the story is the fact that we have also seen that high yield US bonds have not, been much affected by the hikes of the Fed. So somehow it's probably not linked only to an improvement in emerging market framework. There's other stuff going on. It could be the US economy was stronger than expected. It could be the role of the IRA. But maybe, and this is something I think we can talk about more, maybe it could be that liquidity is still very high, in fact, or still quite high. Global liquidity is still quite high, and that has decreased the pass-through of global financial conditions of the US monetary policy hikes into global financial conditions and into both emerging markets and risky assets and high yields bonds. If this is the case, then that means we'd better be quite careful because that liquidity in financial markets, okay, is also linked to relatively favorable valuations of risky assets. We know where the US stock market has been, okay, and that may not last. We must have some corrections in that, and if we may have other shocks, other very significant macro shocks coming from the US, not linked to monetary policy, and if that leads to decreasing the amount of aggregate liquidity and correction in asset prices, then the pass-through might increase. If and the interest rates stay higher for longer, then we might reverse a little bit the good surprises that we have had so far. So to conclude, I think very much US monetary policy is still a major factor for international finance. However, the recent hikes have not had the degree of pass-through that we would have expected from historical data. And I think that may change if we see a tightening of financing conditions, which could be due to, a few different shocks that we might expect in the current circumstances. And let me stop here.
Okay, great. Thank you, Ellen. So I think we'll just head straight to Anusha, and then we'll open it up to discussion. So go ahead, Anusha.
Ellen, just thank you very much for inviting me to be part of this very interesting discussion. It's a pleasure to be here and also share the stage with Ellen, who gave us such an interesting and lucid overview of monetary policy linkages with particular attention to the international spillovers. So I'm going to go a little bit more into detail on this, pioneering work that Ellen has done, and also try to bring some additional points for us to discuss in terms of moving forward the potential for geoeconomic fragmentation and pushing a little bit about those not so nice surprises that are already here and might be on the horizon. So let me sort of continue. Ellen's work on the global financial cycle has shown us that risk shocks export push factors. So these are factors that originate in advanced economies and have an impact on capital inflows and outflows into emerging markets with attendant consequences for monetary policy autonomy in emerging markets in particular. And this really came into sharp relief, in the aftermath of the global financial crisis and the period of quantitative easing, where interest rates reached the zero lower bound in the United States and other advanced economies. And we had a huge wave of capital flowing into emerging markets with potentially destabilizing effects in those markets. And it's sort of evocatively summarized by President Dilma Rousseff of Brazil, who characterized this as a monetary tsunami that hit emerging markets. Now, in work that I've done with Carly Dill-Stedman and Christian Lundblad, we sort of take this identification of U.S. monetary policy shocks seriously and estimate an affine term structure model using these unexpected surprises in monetary policy and looking at the impacts on both risk premia as well as short-term yield, focusing on this period of unconventional monetary policy. And so we focus both on the period of quantitative easing as well as of what Ellen talked about, the taper tantrum episode where Ben Bernanke made first mention of tapering in congressional testimony. Echoing what Ellen said, these unexpected monetary policy shocks, what we see is that they exhibit sizable effects of U.S. holdings of emerging market assets. And what is interesting is that the effects manifest disproportionately via valuation changes rather than physical flows. Now, this is important because valuation changes impact asset prices, which in turn have impacts on household wealth effects via household wealth effects, as well as collateral values for financial intermediaries as well as firms. And so when we have these big asset price impacts via this portfolio rebalancing of international investors, that poses quite a few dilemmas for emerging market central bankers in particular, especially when confronted with a reversal of that monetary monetary tsunami. What we also see is that we see these effects are much more pronounced in equity markets relative to bond markets, and also that there is an asymmetry between periods of quantitative easing versus quantitative tapering. And, the paper is this paper on taper tantrums and QE and its aftermath. So what we also saw in the aftermath of the global financial crisis and the fact that it had, one of the root causes was sort of the financial stability implications of the banking sector not being appropriately or sufficiently regulated. There was a huge push towards macroprudential regulation by looking at leverage ratios and regulating the banking system. And so in subsequent work with Carly and Kristen Forbes, what we looked at is the interaction between the implementation of macroprudential regulation for the banking system and how this impacts emerging markets in terms of the vulnerabilities that they face when they're in response to the global financial cycle. So there we really asked this question: how do macroprudential policies affect portfolio flows at different phases of the global financial cycle? And what's interesting is that there we uncover the fact that these effects are not really notable during normal times or when we are not in a period of financial stress, but they become very large and significant in times of financial stress, especially in what we call risk-off periods. I'll get into that a little bit more. And there are these important interactions of these macroprudential regulations with the global financial cycle that amplify the impact of risk shocks, particularly on fixed income flows. And the type of monetary policy tool also matters, where loan to value and foreign exchange regulation measures amplify these risk shocks, whereas other tools such as the countercyclical buffers less so. So what emerges from this literature is this work is that when we regulate the banking system, the concerns are that some of the risks migrate in important ways that to other parts of the financial system that can further increase the vulnerability, particularly of emerging markets, to the global financial cycle and global risk shock. So we can talk maybe a little bit more about the regulatory perimeter, but this has really brought us to a point where we started thinking a lot more about the multifaceted nature of global risk shock configurations. And we've talked a lot about US monetary policy, but it's also important to remember that independently and interacting with monetary policy shocks are the impacts on global liquidity and funding conditions, and together with that, the impacts of exchange rate shocks. And the main point that I'd like to make here is that a sort of an interaction or a multifaceted risk shock configurations can impact foreign investor risk aversion, the risk-bearing capacity of international financial intermediaries, and this international capital market liquidity. So in subsequent work, we've really been focused on measuring global risk and evolving from unitary sources such as the VIX to more composite measures that encapsulate variable sources of global risk, and drawing upon multiple financial assets to summarize these risk-on, risk-off states of the world. And I think Helen's global financial factor is also work in that direction. So once again, you can have the impact of US monetary policy surprises on these risk indicators, which in turn impact foreign investors via the international risk-taking channel and portfolio rebalancing. And these risk transmission mechanisms can be amplified via market liquidity spillovers, and as I mentioned earlier, the asset price impacts. So when we're sort of moving towards a more multifaceted measure of this time variation in global risk appetite, I think it's important to consider the fact that, corporate credit markets, risk emanating from there, advanced economy equities, part of which is captured by the VIX, global liquidity conditions, currencies and gold, all of this sort of interacts with what's happening in terms of US monetary policy and has spillovers. So this really brings us to, there's been so much attention that is being paid to financial intermediation via global banks and the global banking system, that I think it's important to take note of the fact that with this increased regulation of global banks, we have changing players in financial markets, and that has further consequences and ramifications for international shock transmission. So this, Hélène talked about her student Tatiana's work on mutual funds, and this really falls squarely in the area of non-bank financial intermediation, of which we see an unprecedented increase and a change in composition of the financial flows to emerging markets, where nearly half of the external financing to emerging markets has been in the form of non-bank financial intermediation. So, we welcome the fact that these diverse forms of financing are actually helpful to emerging markets. But what I'm going to show you in a second for a couple of minutes is that the underlying mechanisms or the underlying structure of these non-bank financial intermediaries, focusing on mutual funds, open-end mutual funds in particular, is that these intermediaries themselves are inherently more vulnerable to liquidity and redemption risks, especially in periods of global financial market stress, and have implications for tail risk in emerging market asset prices. And what is surprising is that while we have encouraged this increase in index investing or passive investing, if you talk to any financial advisor, you're told not to invest in individual stocks, but to invest in these index funds. These index funds are benchmark-driven investments that actually, what I'm going to show you, are particularly sensitive to global risk shocks, because they can en masse, in a passive way, depending on the risk shock and the nature of the redemptions, they can pull out en masse from emerging markets. And the procyclicality of these investment fund flows during times of global stress really poses some important financial stability concerns. So the bottom line here is that these open-end mutual funds face rapid redemption requests, so they have very liquid liabilities, but the underlying investments, especially in emerging markets, are illiquid assets in emerging market equity, or even more illiquid emerging market debt. And it's important to remember that unlike banks, these mutual funds do not have a liquidity backstop in the form of the central bank stepping in. And so managers generally have to liquidate or increase their investment positions to meet investor redemptions and subscriptions. So this is really a new channel in terms of a shock transmission mechanism, where in response to funding shocks from their investor base, my co-author has shown in other work that global funds substantially alter their portfolio allocations, to the point that in the IMF warned that these mismatches on NBFI balance sheets pose a major vulnerability and risk to financial stability. And this is really very briefly a schematic representation of open-end mutual fund trading, where you can see that if you have global risk shocks, that translates into, say, redemptions. Once these funds run out of their cash reserves, if they have invested in illiquid emerging market equities and bonds, that results in trading, which is buying and selling. which is really these capital flows, which have impacts on returns. And it's really the root causes these investor fund liabilities are incredibly liquid, and the underlying heterogeneity, it's really the passive funds that are indexing and the underlying fund management machinery that really drives the variation in these potential amplification effects. I just have a few minutes left, but I just want to show you that we can sort of look at country by country what happens, and these one standard deviation equity liquidation by these open and mutual funds has sizable effects on both currency depreciation as well as aggregate equity returns, be they in local currency terms or in foreign currency terms. And if we look at the distributional impact, if we really look at the tail events of extreme financial market stress, these effects, as you can see at the bottom of the slide, are really very significant. So the bottom line here is that extreme capital flow and returns realizations are tied to global risk appetite in this more multifaceted manner. And the fund management machinery increasingly is facilitating this cross-border investment. And we talked earlier about the interaction with macroprudential regulation. So some policy implications here are that is there a need for a macroprudential approach to investment fund regulation, because these funds are more or less outside the regulatory perimeter at present. And, what are the reforms that we can undertake to mitigate these redemption risks, the procyclicality and the herding associated with these investment funds? And really, should we be thinking about, in addition to these capital buffers, should we be thinking about liquidity management tools such as countercyclical liquidity buffers, analogous to bank capital buffers, and liquidity stress testing to gauge portfolio liquidity? So in work that actually Hélène asked me to do, I had sort of noted that policies to strengthen the resilience of emerging market financial markets to global shocks will ultimately need to address the underlying currency and liquidity mismatches associated with non-bank intermediated financial flows. So let me sort of conclude by talking a little bit about considering the monetary policy autonomy under new circumstances. So Hélène gave us some very good food for thought in terms of, what has made emerging markets more resilient in the current episode in the post-pandemic period. But what we also see is that for U.S. monetary policy to have these international spillovers, it's important that the United States continues to, and the U.S. dollar continues to have the heft and the weight that it has had and the role that it has played in the international monetary system thus far. And what we see is a number of trends that are leading towards de-dollarization. It may not be as significant as we saw in Hélène's, the international financial network has continued to be unipolar so far, but I'm just sort of looking forward in light of the geoeconomic fragmentation that is rapidly coming into view in terms of the ramification for monetary policy transmission mechanisms that are really intertwined with the international role of the dollar and the dollar-based global financial system. So a question that I would really like to pose to all of us for discussion today is, how might we think that the U.S. monetary policy role may change given this geoeconomic fragmentation and potentially financial market fragmentation? There is already work that has shown the stealth erosion of the dollar as an international reserve asset. Linda Goldberg might have more to add to this, but we also see a rebalancing, particularly recently, into gold, into non-traditional currencies such as the Australian dollar and the Canadian dollar. And on the one hand, all of this might provide much welcome competition in the market for global safe assets, but it also sort of raises questions about monetary policy autonomy for emerging markets that might be coming from competing blocks, as we see the rise of renminbiization and the rise of the petro yuan. A lot of contracts now in Africa, in particular, being denominated in renminbi. And finally, a point that I'm just going to throw out there, we can talk a little bit more about, is the rise of digital currencies, in particular, the potential for central bank digital currencies and the implications for monetary sovereignty. Are we going to see more e-dollarization? Are we going to see more use of domestic digital currencies? And of course, recently all the talk about the role of stable coins that has arisen. So why don't I just stop there and we can talk some more.
Thank you, Anusha. That was fantastic. So usually at this point we move on to sort of a dialogue between our two speakers if there's any kind of particular points that they would like to respond to. So why don't we go over to Hélène if you have any comments on Anusha's presentation or kind of building off of some of the themes that have been brought up.
Yeah, so Anusha, I mean, as expected, that was a great presentation, and it's a really a fantastic body of work that you have done, and I think it's very nice because it connects both the standard banking system, the macroprudential tools, and then the effects on the NBFI, which are becoming more important. And so, I mean, on that respect, so there was a couple of points that I would love it if you could expand a little bit more. So one of the points that you mentioned is this effect of global risk shock on essentially instability of portfolios and price effects if there's liquidation. And I'm wondering whether you have a little bit more to say on the cross-sectional determinants of this. So whether you see any particular characteristics of the different equity markets of emerging markets or their macroprudential framework or whatever that kind of explain a little bit the price effects and the volatility. I mean, as we know, what is very interesting in the cross-section is also that when there is a market clearing condition that has to adjust, it can be either cleared by the equity market moving, or it could be cleared by the exchange rate moving, or it could be cleared by the fixed income. I mean, there's lots of possibilities here. So I think if you had any thoughts, I mean, I'd be very grateful, because I think this is very important also to understand the policy consequences better. And obviously, I'm also totally interested in discussing further, I think, just like you and maybe a lot of people on the call, these issues about e-dollarization and future role of stable coins and the possibility of, I mean, in the RMB, I'm a little bit more maybe cautious than what you said in the last slide in terms of whether it is very significant or not. I mean, for the moment, I think most data are going to show, yes, it's true, an increase in, yuan denominated invoicing, yes, but it's going to be an increase within a very, very small, at a very, very small level. So it's not so clear to me that this is something that can take off very rapidly. On the other hand, these issues about these dollar stablecoins and also what the current administration wants to do, either with crypto or with dollar stablecoins, it's not clear to me actually what their position is there. If people have some views on this, I think it would be very, very interesting, because obviously having dollar stablecoin is another way of having more dollar, right? If it's fully backed, that means more demand for US treasuries. So is it where we are going? Is it going to be boosted by the current administration? What do we know about this? That would be great.
Thanks, Ellen. So let me sort of respond, and also I'd love to get your thoughts about, what we think about um, the way in which the global financial cycle may evolve if we move from a unipolar global financial system to, it could be it may be China, but it could also be Europe, right? A stronger Europe, as we're hearing today. So I'd love to discuss that a little bit more. But in terms of, what's really interesting in terms of the instability of NB5 flows, especially through open-end mutual funds, the really surprising result for us was that, we did that whole looking at, our countries that are more stable macroeconomically. Are they, less vulnerable to emerging market, to portfolio rebalancing away from them in response to, say, monetary policy tightening or these risk shocks? I think the really surprising finding of our research is the extent of indexing that is present in this open-end mutual funds. So what happens is, I think what is really important is this political economy of how the index is created, and the weights that are assigned to different countries. So China, for example, was not in the index till about 2017, 2018. But when it came in, a very sizable fraction of weight of like over 30% was assigned to China. And what is interesting is that this is why I was referring to that passive rebalancing, right? So let's say an open-end mutual fund has a redemption of 100 million, and they have a mandate of indexing to the MSCI Emerging Markets Index. So the way that they rebalance is in a passive way, based on the weights that have been assigned to that country. And what is surprising is the degree of concentration in these index funds, where, the Brazil, India, China, South Korea, Taiwan, these are the countries that have very big weights. And, the top companies in these countries account for about 25% of the weight in these index. So just 10 companies, like Taiwan Semiconductors, Samsung, Alibaba, Reliance from India, etc. These are the ones. So this was the surprising finding, or, an unintended sort of, it was something that we weren't expecting at all, is that most of these instability in the financial markets and the asset price impacts are coming from rebalancing by passive funds. And so then what really matters is taking that step back and saying, what are the countries, what are the companies that are getting included at a micro level into the index, because that is what is driving the rebalancing. Yeah, I would absolutely love to discuss a little bit more. And, whenever we think about central bank digital currencies, I always think about, the old Jevons sort of, money is a matter of, it's like the four functions of functions four, which is money as, medium of exchange, as a store of value, as in a standard in a store. And so it's really a question of, what role are these central bank or other digital currencies going to play? And that sort of, we can sort of work out from there if there's a foreign CBDC that is in use in an emerging market economy. Then we could see that, that would substitute for the domestic currency and make, infringe upon monetary policy autonomy for the domestic central bank. But on the other hand, if domestic CBDCs come into play and are used in transactions, etc., you could see that monetary policy might actually have a stronger impact, right? And also by providing competition to bank deposits, for example, it could either, I'm not quite sure where this is going to go. Is this going to lead to a tightening of financial conditions, Or is the fact that, bank deposit rates tend to be sticky, but, now that we have another player in town, like the CBDC, is that going to compress spreads and increase the transmission of monetary policy and really increase the strength of that? And what does that mean for wholesale funding markets, et cetera? So I think there's a lot of different mechanisms, but I think it's important to sort of think about these functions of money. What are these CBDCs going to function as? Are they going to be a medium of exchange or a store of value? And then we can think about, the market for safe assets. But let me just sort of leave it there. And I'd love to hear Helen's thoughts about, the transmission of, and I realize that, renminbiization is not really all that. It's gone from about 2% to about 7% of the transactions that are taking place, and capital controls, et cetera, play a role. But in light of the geoeconomic fragmentation, like especially in the China bloc, in countries in Africa, the denomination of contracts in renminbi, how is that going to play out? And also, I'd love to talk about the role of Europe.
Yes, so I'm also very fascinated by the same set of issues of Anusha, so that's great. So on this, what we have seen, I do agree that there is a tendency right now to avoid sanctions, and therefore that leads to some bilateral trades that are intermediated or are trying to be intermediated out of the dollar. But so far, what it really has meant is some kind, almost like a barter style system, right? Because if you do ruble against rupees, then you're stuck with your rupees. There's not much you can do with the rupees, and if you are stuck with a ruble, there's not much you can do with the rubles either. So it's so far, at least, until there is a proper ecosystem that is being constructed around an alternative medium of exchange to the US dollar. We might have all kinds of different payment systems being elaborated on an ad hoc basis, but it's not going to really take off. You need the ecosystem, so that means you need the mechanism to have liquidity and to other people to accept the medium of exchange. You need a bit of a store of value, so liquidity in bond markets. You need additional financial instruments. You need, and this is not there. And we know that from the Chinese side, it's very difficult to get any of that with capital controls. So despite the fact that we see a bit of, yes, we'll see more invoicing, because if you have a Belt and Road initiatives and you ask people to pay for your commodities or your goods in RMB, yes, you're going to see a bit more invoicing, you're going to see a bit more exchange in RMB, but that's not going to be a viable ecosystem in the short run. Now, there's a lot of very interesting issues around, I think, stable coins and possible dollarization. I want the other people to speak, but I just want to give an example. I have an MBA who came to me and he said that, in London, some people working and himself is paid in dollar stable coins in his job, right? And so the way some of his jobs work now is that you pay in dollar stable coins. You have your wallet full of cryptos, so you use all kinds of exotic cryptos, a store of value. You can gamble of them, get capital gains on them, and then you can convert them instantly in dollar stable coins, and this you can use as a medium of exchange. Now, if this is a generalization of what is to come, right? I think this has a lot of implications actually for monetary policy and for other things. But so for the moment, obviously, it's not that common, but I don't see why this would not be becoming more common, actually. So let me stop here for a moment. Yeah.
Okay, great. So we can move on to the Q&A. So I think Katerina had her hand up, and I would just before that like to reiterate, as Katerina is my employer, I'd like to reiterate that I would like to not be paid in stable coins. I appreciate continuing to be paid in US dollars, at least for now.
It's 1 for 1.
Yeah, it's backed. It's fully backed.
It's fully backed.
That's the beauty of stable coins, right? So maybe that's why they arbitrage with the other stuff and then go back into stable. My question is really the one that I think Hélène raised, but I think it's significant for the entire global system, and that's the insurance. So it's the exorbitant privilege to have the global reserve currency, and it also can be an exorbitant duty and obligation to bail out the system. Now, and I think that's where the politics of the current administration come in, and the lack of similar systems elsewhere. So I'm just I think the more I listen to you, the more nervous I become because I'm thinking about these mutual funds as amplifiers and certainly not being able to be buffers against a liquidity run, and then thinking about if the US steps out of this role of being the global insurer, is there I don't see an alternative. Let me just say this and then ask you, do you see anything else that could step into that role, which I think has major ex ante impact also of how people position themselves as the markets become more volatile and fragile. Thank you.
I can start. I think this is a very obviously important concern. But I think there are two kind of issues. One is, as Anusha pointed out, we go from a system of banks to a system of non-banks. And so there, the lender of last resort, it's not so clear whether you want to provide liquidity to any type of non-bank financial intermediaries which is not regulated in a way that the banking systems are. So there's a first set of issues to sort out there, and the Financial Stability Board is thinking about these issues. There's going to be another set of actors if stablecoins get developed, which also might be under, liquidity strain. I mean, are they going to be really fully backed, not fully backed? Even if they are fully backed, you might think that there will be a need for liquidity of last resort. So that's the first set of issues, which has to do with the type of actors and who we want to provide liquidity to, and under what conditions, what type of collateral, etc. And then the second set of issues is the kind of international swap lines issues. And there indeed, so we don't like when politics get too much into that, but it does seem like the current administration will probably not be so forthcoming, or would probably look a little bit more at what's going on in terms of international swap lines. We do know that ex ante, actually knowing that this is something that is affecting the desirability of safe assets, right? So there's work by Ricardo Rice, for example, who are going towards those issues. So the global safety of the assets and this kind of mechanism of insurance that I've been working on with Pierre-Olivier about what happens, in bad times. You do want the global safe asset to be safe, and if everybody believes it's safe, also there is this appreciation of a safe asset, and that's a wealth transfer from the US to the rest of the world. That's really an insurance transfer. Now, if you don't have this kind of liquidity last resort role of a Federal Reserve in bad times, I think this would definitely be an issue for the role of the dollar as a global safe assets, and an issue in terms of providing this insurance stuff. So who could step in? So the ECB is the closest then, and we had written actually with Linda a while ago a piece on that. The issues that the ECB and the euro have to solve is still the resilience issue. So in bad times, we tend not to have a safe asset in the euro area because we have effectively partitions of the euro area bond markets. We have flight of capital to the core from the periphery. And so this is not a super resilient financial system. And for a global safe asset, you want precisely that in the risk off states of Anusha, you have a resilient bond market. You want the people to be willing to hold that thing. So that's something that the euro area has been working on, actually, because we have ESM. We've done a lot of things since 2011 and 12. So maybe the euro actually is much more prepared now than it used to be for this type of global safe assets. And after all, the macroeconomic numbers of the euro area are actually, in terms of overall debt, etc., look better than the US. So that's an interesting thought, right? That if there is sufficiently messing up with the dollar, then actually the euro might not look so bad as a global safe asset.
Would you like to jump in there, Anusha?
Sure. Yeah, no, I absolutely echo what Ellen is saying, that I really think it's important to have competition in the global market for safe assets, so you don't have just one game in town, and that a game in the dollar, which is becoming, that has the potential to really, its role is really coming into question, especially with the new administration. Full disclosure, I worked in the old administration. But, and there are also these notions of, it's not an exorbitant privilege, but I often heard the term exorbitant burden, which is that because of the US, the dollar's role in the international financial system, the dollar, we have a strong dollar, we have a trade deficit, and US exports are not competitive for that reason, and therefore it's an exorbitant burden and not a privilege. And if that sort of thinking starts to take stronger hold, especially when I've seen things being floated by the current administration that foreigners, we have to provide the safe asset, and therefore foreign purchasers of safe assets must pay a fee to buy treasuries. If that sort of thinking starts to take hold and come to fruition, I think that we could find ourselves in a position where, we're looking for other safe assets, quite quickly. And as we see through the movements into gold, right? We see that gold prices have really sort of taken off. Of course, it's not easy to transact in gold, etc. But still, in terms of its importance and the valuations we're seeing in the gold market, I think all these issues of who is the global financial stability network and who's going to be providing this insurance. And the Fed has played an incredibly important role. Linda and I have been working on some stuff related to, the swap lines, the bilateral swap lines, the expansion of those during the COVID crisis, the FEMA repo facility, etc. I think all of that is really is at risk if the dollar's role is compromised in any significant way.
Okay, great. Thank you, Anisha. So I see we have a question in the chat here from Anna Galpern. So she has to leave relatively soon, so I'll maybe let her jump in with her question just to make sure it's addressed before she has to go. Would you like to ask it verbally, Anna, or do you want me to read it out?
I mean, sure. Basically, is national securities regulation irrelevant? Right. I mean, just listening to the two presentations, it was really interesting because investment funds are clearly a sort of a focus for studies of monetary policy transmission, but they're regulated very differently in different jurisdictions. But that doesn't seem to matter whatsoever, which actually, I mean, this is not my field. There may be securities folks on this Zoom, but I just want to, first of all, double check that that's right, and then think about why that is and whether that has changed. So, and also that I think might affect how we look at insurance and everything else. So, if retail investors are putting their money in, if basically the flows are those of retail investors, then I think the outcome is potentially different than if it's, sophisticated investors and whatnot. And alternatively, if it's all exempt funds, then I think we think of this as quite differently. So thank you.
Okay, great. Would you like to start maybe, Anisha?
Yeah, sure. I think, and I bring up a really important point, and that's sort of like some of the policy implications that I was talking about towards the end, is that these funds don't have a liquidity backstop like banks do, right? So the money market funds experienced disruptions during the COVID crisis, and then this money market stability fund had to be established. But, moral hazard writ large, right? That if you get into trouble, you're not in the regulatory perimeter, but you're going to get bailed out if you run into trouble. So I think it's really important to think about the regulation of these funds. And I think the Treasury, you know, under the Biden-Harris administration was definitely thinking about the implications and how to go about you know, addressing some of those regulatory issues, but nothing definitive has been set up so far. And what we do see is that it's not just the retail investors. Retail investors are encouraged to go into index funds that are then subject to quite a lot of volatility. So, you know, what can we do in terms of policy to maybe have liquidity stress testing? But in order to do all of that, you know, the first step would be to have to bring this fund industry into the regulatory perimeter in the way that they have not been so far. I mean, banks get regulated, so, and you have stress testing, and then you have the you know, the liquidity backstops.
I can just add, but that
Yes,
so there's obviously a lot to be discussing, you know, the scope for moral hazard versus liquidity lending in crisis for all these actors. But within the European framework, in terms of macroprudential policies, actually funds are within the purview for the macroprudential authority. So, for example, in some jurisdictions, so we do have tools, for example, to put some swing prices or some gates to all the funds, for example, in order to avoid stigma, to avoid runs. So it depends very much on the legal framework of the different countries there.
so I think we'll go over to Perry Merling, and then we'll get to Linda Goldberg's question in the chat here.
My question is a very simple and easy one. Anusha, you mentioned in your initial beginning of your talk that you found significant difference, asymmetry in positive shocks versus negative shocks. And I would like to hear maybe a little more about that, particularly, and maybe also from Helene, since you basically only talked about negative shocks, you know, and increase in interest rates. Is this, and possibly by construction, these impulse response systems may assume symmetry. So I guess I'm asking if you've assumed a symmetry, or how do you deal with this asymmetry? What are the facts and so forth? Symmetry versus asymmetry.
Yeah, so very quickly, what we found is that the impacts of during QE were not necessarily consistent across asset classes, equity versus debt, flows versus asset prices, etc. But when it came to the first mention of taper, and as Hélène had said, this wasn't even an actual tightening. This was just Ben Bernanke talking about tapering, and in congressional testimony, we start to see these big effects, which are very consistent across the board. And I think that this is related to the asymmetry between risk on and risk off shocks as well, because I think risk off shocks you know, suggest states of the world where global financial conditions might be tightening. There might be flight to safety. That's another thing we find in our results, is that when you have a risk-off shock, we have rebalancing out of risky emerging market assets, but into safe treasuries. So you know, we see both of those effects. And so I think this, in a risk-off world, the role of safe assets and the flight to safety also become really important. So I think that there is a asymmetry in terms of you know, risk on versus risk off.
Yeah, I fully agree with what Anusha said, and just would add that for many of the models we are going to write down that I think are relevant with financial frictions for crisis. So if you have some types of constraints, you're going to hit those constraints possibly in risk-off episodes. And so the dynamic is going to look very nonlinear and different in risk-off versus risk-on.
Okay, great. And so I see, sorry, did you have a response there, Perry, or is that?
No, that's fine.
Okay, great. And so I see Linda has a question as well, and she's still here, so go ahead, Linda.
I'm going through some kind of software push right now, so apologize if I drop. So I'll have a new paper that I put in the chat that's going to be released next week. But basically, it's looking at volumes of funding flows through banks and non-banks for financing debt issuance. So I wanted to just flag that, there's a lot of time variation, a lot of cross-sectional heterogeneity in risk sensitivities by type of borrower and very much by the conditions of the source countries for these funds. So when you talk about the prudential policies, it's not even necessarily the ones in the country that's receiving funds and setting policy, but in the countries that are funding them. So my question for both of you follows on the fact that a lot of the evidence presented are by both of you is on prices, where the impacts of policy, monetary policy and risk conditions is on prices. Of course, we think about both prices and quantities, and which do you think matter more for the real economy? That's my question. Or how would you think about that difference?
So first of all, Linda, I also presented a lot of evidence on flows and credit and leverage. So quantities and prices for me are always jointly determined. And this is why I've always been very puzzled by most of the finance literature, who systematically looked only at prices without having joint determination of portfolios. And in fact, all my work has been to determine jointly in equilibrium quantities and prices. And I think quantities actually are very important in many dimensions. What I also know is that from trying to predict financial crisis, quantities are extremely important to assess the risk buildup. And this is also related to the work that obviously also Alan has done, etc. It's not only credit growth, but all kinds of measures of risk buildup rely on quantities, and they are much more forward-looking in some sense than the prices. So I would totally agree with you that 100%. Quantities are up there and should be always looked at jointly with prices. But before you leave, I don't know if you want to, but I wanted also to ask you, because you also have a paper on reserves, right? And the role of dollar in the reserves. And I think you're showing that actually it's quite surprising, but it doesn't go down at all. And if in some countries it goes down, it's not at all the country we would expect it does. So I wonder if you could also say something about that.
Should I also, Anusha, on the question?
Yeah, sure. So I think I think we're sort of international macroeconomists who work in international finance. So we appreciate both, the effects of both quantities and prices. And in fact, the data that I showed you on the price impacts is really coming from the quantity, right? So it's always hard, like they're simultaneously determined, but what we see is that it's these liquidations that have these huge price impacts, right? And so it's really the channel in terms of risk-off shocks is really operating through subscriptions and redemptions, which is leading to buying and selling, which is really quantities, right, in terms of the flows, which in turn has price impacts. And then, of course, the finance models come in there when you have asset price impacts, you have wealth effects, collateral values are impacted, credit constraints, et cetera, in the financial intermediary settings. So yeah, completely. The evidence I showed was related to the impact on prices, but it's really coming from the exercise is really looking at liquidations. And so I'll let you talk about the paper, which is really, the Barry Eichengreen work and Linda's work are, it's this conversation that's happening.
Yeah, so I just very briefly, it's if you look across countries, it's not that there's a generalized reduction in the dollar share of foreign exchange reserve portfolios. There are countries that increase the dollar share over time, as well as countries that have reduced dollar share. And even with sanctions and geopolitical distance from the United States, sometimes that actually is even associated with a higher dollar share of portfolios, which is contrary to some of the discussion out there. But I'll leave it at that for here.
And I just wanted to say also your point about the origin countries for the capital flows as being a very important element of the sensitivity of flows, I think is spot on, right? Because indeed, if we believe in these financial frictions, and they originate in the investor country, and this is also where we have to look at the buffers, etc. For policy, I think it's really very important, and I think it's related to also what Anusha finds and so on. So I think this is really the type of research we need to build policy on. It's not only the recipient country, it's really the source countries.
Okay, great. So we're nearing the end here. We have time for, I think, probably one more question. And since I don't see any hands up, I will take it upon myself to ask another question here, which is about a point that Anusha brought up sort of at the end of her presentation on the pro-cyclicality of passive investment and efforts to try to think about ways to mitigate herd behavior. Because it seems to me like there are policies we can think of trying to apply macroprudential regulation to funds to try to reduce the amplification of shocks that they might have. But I'm struggling to think of ways that we could sort of mitigate the inherent pro-cyclicality. It seems to me like there are just inherent features of passive investment that make it pro-cyclical. And so I'm wondering if it is really just a matter of applying, bank-like regulations, or if there are other things specifically that can be done to try to mitigate that pro-cyclicality.
Yeah, so I think Ellen brought up the points about what's been done in Europe, which is the swing pricing and gates and so on. But I think the fundamental dilemma here is the fact that these funds are not regulated and therefore do not have a ready-made liquidity backstop, right? So if we have, we do this, we provide liquidity backstops to banks to prevent bank runs from destabilizing the financial system. But then, as I mentioned earlier, these banks are very heavily regulated and so I think that is the fundamental issue with the pro-cyclicality, is that if you're in a risk-off world, and really one other point that I didn't make is that while these funds also hold cash buffers, cash does not earn anything. So the other kind of issue here is that fund managers' performance is indexed to their asset class. And if you're holding a lot of cash as a liquidity buffer, that's not going to be making any returns. Then when there are also these concerns about compensation at the end of the year, where bonuses are, this is really getting into the nitty-gritty of the fund industry, but so fund managers are really loath to keep much in cash. So once those cash buffers run out, then you are in a position in a world where you have to liquidate the underlying investments. And what's interesting is you're seeing it not just in the open-end mutual funds, but also in terms of ETFs, which are the other asset class that is really rising in prominence. And you would think that ETFs, the underlying machinery, would allow these ETF managers to, give them some leeway in terms of when they sell to the investor or redeem whatever the investor is trying to sell. But at the same time, they have some time to liquidate the underlying investment. But we see the same volatility in ETFs as well, so I think that's the fundamental mismatch, is the lack of liquidity, and how can macroprudential regulation address those liquidity stress testing or liquidity, the provision of liquidity, while at the same time keeping in mind that just a blank check is just going to lead to more moral hazard.
Right. Okay. And Ellen, do you have anything to add here?
Yeah, no, I think I fully agree with what Anusha said. And I just think also that regulators should be particularly worried when they see a huge maturity mismatch and, open-ended fund with a very liquid asset, real estate asset, etc., as we have seen, right? It doesn't seem to be a right design somehow to have extremely liquid balance sheets with people who can withdraw their liquidity at any time. Doesn't seem to work. So I think this type of things should be seriously limited.
Actually, I had a question on a similar topic about the measurement. Since you gave me the word, maybe I will ask it before leaving. And it's more of a provocative question. It's an open-ended question. Of course, it doesn't come directly from your work, but as a speculative point, I was wondering. I find very interesting the point about benchmarking because it's a clear example of fallacy of composition. The market is giving me the benchmark against which I have to compete, and that unravels the whole financial instability. So I was wondering whether, from a macroprudential point of view, we should be thinking also about promoting different benchmarks, like risk-adjusted benchmark or safety-adjusted benchmark based on the cash flow the cash buffer that you also have, so that there's not only a single measure of return. And another point, which is unrelated but still reflects these macroprudential policies that I had, is who should regulate these funds? Like, even if we are talking about MBFIs, in the moment in which they are global, like who should be under the purview of the Financial Stability Board? Like, is it like an international organization, the BIS? Should we construct a new agency for that? It seems like it's very hard from a legal perspective to pin down who should oversee them.
Would either of you like to start there?
Sure, I can just give you a few reactions, one is that, like this SEC regulates securities in the United States. And so then the Treasury was really trying to, under Janet Yellen, really trying to think about, precisely these questions of, who would regulate and how to regulate, et cetera, without, whether it would be existing agencies or new agencies. I think a more fundamental issue with, in terms of how fund managers get compensated and get their bonuses, et cetera, that really has to do with the whole fund industry itself and how it operates. And, proposing alternative benchmarks may fly or may not fly. It depends on what kind of instability or what kind of, I don't know, Sharpe ratio we're getting from these returns, perhaps just off the top of my head. But I think a more fundamental issue is, the degree of concentration in these indices. I've been really, really astonished that, the 4 or 5 countries account for 80% of the index. So, you might be thinking you're investing in an emerging markets index, but you're really investing in, India, China, Russia before Russia was dropped from these indices, Brazil, Taiwan, and South Korea. Those are the 5 countries really that you're holding in an emerging market index. And so, that to me is the degree of index concentration is really something that I don't know what we can do about.
Yeah. So on the regulation, I mean, so the market authorities are usually supervising those funds, but in places where you do have macroprudential authorities, namely in Europe, the purview of the authorities are both actually the banking system, but also the funds, insurance companies, etc., and their interconnections. So this is why you might have their tools to use to stem potential runs on the funds, etc. And to the extent that the interconnections of the funds with the banking system cause a systemic risk problem, then it is in the mandate of a macroprudential authority to do something.
Yeah, but the only problem that I have with that is that to the point where they're not nationally determined, then it creates clashes.
But the banks are not nationally determined either. But we actually both supervise and have macroprudential authorities on global banks as well. And for banks, the way it works is that if you have let's say, an extra countercyclical buffer for the real estate sector for banks lending in the French market, then any bank, whether based in France and supervised by the French or the subsidiary of a foreign bank but lending in the French market, will be subject to the same additional countercyclical buffer if it does real estate lending. So this is the way currently in Europe it works.
Great. So we'll end on that note, and we'll see you all next month to talk about systemic risk analysis. So thank you again to our speakers. This was a great session.